In 2025, gold once again reached a historic high, briefly approaching $3,700 per ounce. This figure is not only a shock to financial markets, but also represents a shift in global confidence. Why is it that, despite so many options such as the US dollar, treasuries, and emerging assets, gold is still seen as the most reliable safe haven asset? Today, let's break it down from several perspectives. First, let's look at the 2025 performance. So far in 2025, gold has risen more than 26%, significantly outperforming many stocks and bonds, as well as most commodities. Even compared with energy, gold remains among the top performers. At the same time, the US dollar index has fallen from the 2022 high of 114 to around 100 today. Historically, gold and the dollar have a negative correlation of around -0.5 to -0.6. In other words, when the dollar weakens, gold naturally becomes a preferred destination for capital. The reason behind this is clear: US economic growth expectations have worsened. According to the CBO and several institutions' latest data, 2025 US GDP growth has already been revised down from nearly 2% to around 1.4 to 1.6%, significantly weaker than the start-of-year forecast. Over the past 2 years, the US continued raising interest rates. Theoretically, this should have suppressed gold, because higher rates make holding US dollars more attractive. But in reality, gold still climbed to historic highs. Rate hikes did not actually hold it back. So what happens if the situation reverses and the Fed really starts cutting rates? With lower dollar returns, capital would naturally flow further into gold. However, it's important to note, rate cuts are not fresh news. The market has long priced in this expectation, and part of gold's past rally already reflected it in advance. In other words, rate cuts will continue to support gold prices, but how much additional momentum they bring may be limited. Meanwhile, the US 10-year Treasury yield has stayed above 4%, without a significant drop despite rate cut speculation. This shows a gap between market expectations and actual trends. Another major driver is relentless central bank buying. In the first half of 2025, Poland bought 67 tons, China added 36 tons, and Turkey and India also increased their reserves. For the full year, net purchases are expected to reach around 1,000 tons. That's slightly below 2024's record of 1,086 tons, but still the second highest in history. According to the latest World Gold Council survey, 95% of central banks expect global reserves to increase in the next 12 months, and 73% even expect their own country to continue adding gold. These figures clearly show that demand from central banks is not just short-term, but a long-term strategic direction. Why are central banks doing this? Because the risks in dollar assets are becoming increasingly evident. US Treasuries may be safe, but their long-term credit is being questioned. With geopolitical divisions deepening, central banks don't want to be overly reliant on the dollar. They need a neutral asset for balance, and gold fits perfectly into that role. As central banks continue sweeping up gold, market supply and circulation shrinks. Once prices break out, and private investors join in, the rally often accelerates sharply. In fact, gold has already become the most actively accumulated asset among global central banks, and this trend will not change in the short term. Another point worth highlighting is that many banks' original price targets have already been reached ahead of schedule. For example, JP Morgan forecast an average of $3,675 for Q4. HSBC at the start of the year estimated a full-year average of $3,215. ANZ forecast $3,800 by year-end. As for Goldman Sachs, their base case was $3,700 by year-end, a level that prices are already approaching. But Goldman also presented further scenarios. If the market worsens, with recession risks or escalating geopolitical crises, gold could rise to $3,880. By mid-2026, Goldman expects gold to break above $4,000. In an even more extreme scenario, if private investors move en masse out of treasuries and US dollar assets into gold, prices could even challenge $4,500. From a technical perspective, every time gold consolidates for a long period and then breaks out, it tends to rally several $100s further. So a move to $3,800 or even $4,000 is not difficult. Looking at reality, some of these scenarios are already happening. U.S. growth forecasts have been revised down from 2.3% to 1.4%, showing recession risk is emerging. Tensions in the Middle East, ongoing U.S.-China rivalry, and other geopolitical risks are already real. Meanwhile, even before year-end, gold has approached $3,700, with private investment demand and ETF holdings both clearly increasing. In other words, gold prices have not only surpassed most banks' forecasts set earlier in the year, they are steadily moving closer to the higher ranges described by Goldman Sachs. Now let's look at international reserves. Some analyses estimate that by 2025, gold's share in global official reserves could rise to 27%, while U.S. Treasuries may shrink to 23%. This would mean that if the trend continues, gold's role in the international financial system could surpass the euro, becoming the second largest reserve asset after the US dollar. This change is symbolic. In the past, many thought the euro could challenge the dollar. But now, gold is seen as the more reliable, institutional foundation. In other words, gold is no longer just a commodity, it has been redefined at the national level as a strategic asset. By 2025, many asset prices have reached all-time highs. Whether US stocks, AI concept stocks, or even Bitcoin, they are all hovering at lofty levels. But keep in mind, US equities' rise has been mainly supported by AI tech stocks, which doesn't necessarily reflect a true global economic recovery. On the contrary, energy and industrial commodities have yet to return to their highs, in part reflecting that real economy demand hasn't fully recovered. Because fundamentals have not genuinely improved, markets still carry risk aversion. That's why investors increasingly prefer gold as a hedge, ensuring that even if turbulence arises, they still have a last line of defense. That said, while gold prices may spike in the short term, the real challenge is whether they can hold at higher levels. If the rally runs too fast, a correction afterward would not be surprising. To sum up, in 2025, gold has once again reached record highs, driven by several key factors: a weaker dollar, rate hikes failing to suppress gold, rate cut expectations, sustained central bank buying, banks' forecasts being surpassed, the rise in official reserve status, and widespread market concerns about risk. In the short term, gold has the chance to test $3,800 to $4,000. But remember, rapid rallies can also bring corrections. One thing is clear: whether at the national level or for individual investors, gold has already become an indispensable asset. The question is, does your own portfolio include gold, helping you hedge risks and protect your final line of defense? Gold's new highs represent more than just price, they symbolize a shift in confidence and safe haven demand. What do you think about the future of gold? Leave a comment and share your view. And don't forget to like and subscribe. In the next video, I'll take you even deeper into market changes.